So here's another good YouTube video I want to share with you on the root causes of the financial crisis, and again, collateralized debt obligations. So let me start.
Marketplace, and I have a little diagram here which will show you how collateralized debt obligations work and how they've affected the financial system and given us the problems that we're in today. So what we have, first of all, is we have a Cdo Manager. This is a guy who decides to create a collateralized debt obligation. And what he has is, in this simile, he has a bottle of champagne. It's a cork. In order to fill this bottle, he goes out to investors and he asks them for money, just like any normal investors. These guys are bondholders. They give him a bunch of money, and what he does is he goes out and he buys a bunch of securities, and they can be anything you want. They can be loans, they can be credit card debt, they can be student loans, but in this case, they were mortgages. So he went out and he bought a bunch of mortgages, and he put them in his bottle. And what he did is he created a capital structure, the same way that a company has a capital structure. And we're going to show this capital structure like a pyramid of wine glasses, just like you have at a wedding. We'll pile up those glasses with the idea of pouring champagne into them, all set in a nice silver tray. And each of these glasses, as a security, is rated according to their riskiness. So the top rate is AAA, this is AA, triple B, double B, and this bottom tray is the equity. We won't worry about that so much at this point. Now, at the end of every month, what happens is the cork pops off because all of these mortgages are paying interest. Causes a great deal of pressure, and all of the money from that interest flows out of the top and into the pyramid of glasses. Because these are the least risky and pay the least interest, they get filled up first. Then the second row gets filled up, then the third row gets filled up, finally the fourth row gets filled up, and then the equity tranche, the big silver tray at the bottom, gets filled up. And everybody's happy. Everybody gets paid, no problems at all. And that's what happened during the housing boom. Everybody got paid. But what happens whenever, say, one of these mortgages, or say 30% of these mortgages or mortgage holders stop paying their mortgage? Well, it means that there's a lot less interest being paid and a lot less bubbly coming out of the top of your champagne bottle. So it means that the first glass may get filled, hence the least risk and the lowest payment. The second set of glasses may get filled, and even the third set of glasses may get filled, but the last set of glasses does not get filled, they're empty. So it's a bit of a problem for these guys, also a problem for the equity holders, because they're not getting paid either. But you've got a whole asset class, a whole tranche of holders that are not being paid any interest at all. Of course, they're being compensated as a result, because their rate was 10% if they did get paid, whereas these guys were 7%, these guys got 5%, and these guys got 3%. Now, where this situation becomes complicated is where you have another asset manager who decides to go out and build a champagne bottle, or have a champagne bottle, but instead of filling it with mortgages, what he decided to do was fill it with these mortgage-backed securities from the Cdo. These are the mortgage-backed securities, and he took, say, one of the glasses from the bottom row, from the double B, because they paid 10%. In the boom, these glasses were generating 10% a month. So he filled this bottle up with these glasses that were generating 10% a month. Now that's no problem whenever this pyramid is full and everyone's paying their mortgages. But if only 30% pay, and the bottom round of glasses is not being filled up, well, suddenly this champagne bottle, when the cork pops at the end of the month, is generating 0. Now he has got his own pyramid of glasses. That is to say, he's got his own investors to satisfy. But unfortunately, when you have a bottle filled with glasses that are not being filled at the end of every month, then nothing is filling the top glasses. Nothing is filling the second row. Nothing is filling the third row. And yet, they are still rated as if they were as safe as the original asset. Now this is the problem. Hundreds of millions of dollars have been invested in this kind of secondary Cdo. And this is the situation that we find ourselves in. These investment managers, Cdo managers like this one here, have gone out and they've hawked these bonds to people all over the country, and in fact all over the world. Pension managers in Norway, through to people at CalPERS and pension managers and mutual fund managers here in the US. The net result is that these investors have packed our funds with these securities which are not paying anything now and are liable never to pay anything again, especially if the situation in the housing market persists and people either foreclose on their houses or stop paying mortgages or default or whatever it may be. The number of people actually paying their mortgages is decreasing, so therefore there's less and less foam coming out of this first bottle, less and less of these securities being filled, and therefore less and less of these AA highly rated securities actually making the money that they were supposed to make. The result is that we're in a mess of our own making, or a mess of these bank managers making, or these fund managers making. The fact that these securities have been poorly rated by the ratings agencies who did not understand the knock-on effect of a few people failing to pay their mortgages has left us all, well, frankly, as Rico says, needing a drink.
So that's what I think that was a really good explanation, and I think that was worth watching. Let me get the PowerPoint back up in a minute here. I just got to fix the microphone, and I'll get the PowerPoint back up. Just give me 1 second here. All right, so we get the PowerPoint back up. So as you can see in those short clips, this is kind of what happened. The payment, the cash flows and the tranches dried up. It's a good representation of champagne glasses. So here you go. The highest rated ones, as we just saw in that those little videos, the superior senior tranches are the ones that are paid off first and so have the least risk. And then the lowest tranches, right, of the CDO, as we saw, is the equity tranche. And this is the first set of cash flows that are not paid out if the underlying assets go into default and stop making payments. So this tranche has the highest risk and is often not traded. So after this large boom, housing prices began a long decline beginning in 2006. So this decline basically contributed to a rise in defaults on mortgages and a deterioration in the balance sheet, right? So basically the mortgages weren't worth anything. So this started causing a run on the banks, the private hidden banks that we don't see. And this spread globally, just like the coronavirus spread globally, right? And this was a sign of the globalization of financial markets here. This is what globalization caused. Now we weren't domestically anymore, so globalization took off, and the T-bill spread, euro dollar spread, euro dollar and the T-bill interest rate increased to almost 240 basis points. So by these interest rates spreading, one was worth a lot less than the other, if you know about bonds, right? As interest rates go up, bond prices go down. So the banks had the balance sheets. They were short on cash and they stopped lending, and they were writing down all these poor assets. And they were trying to sell off these assets, but they could not sell them off, right? Bear Stearns and like Lehman Brothers was stuck with them. And so here we are. So high profile. So Bear Stearns fails, and Lehman Brothers goes under. I think Merrill Lynch bought Lehman Brothers, right? AIG goes under because they had all the credit default swaps, right? And basically all this happens. And it was pretty much bedlam at that point. So the Fed comes up. They come up with a bailout package. The House of Representatives debated it, and it was basically $700 billion. They voted it down, but then they passed it on a couple days later because they had to. There was no choice. So they approved an almost $800 billion economic stimulus plan. And this was the big problem back in 2009 when I lost about $300,000. Okay, everyone was nervous. So here you can see housing prices and the financial crisis of from 2009. So here's 2002. You can see this, the Shiller index, which is a index of housing prices, shoots up, and it's like this is believe it or not, this is where I bought my condo right here, right at the market peak. I bought my condo, and I lost, but I stuck it out and didn't walk away from it because I didn't want my credit to fall. So if it came down in value, and I don't really know where it stands now, the price of my condo. If we're over here at 2020, I don't know if it came back up, but you can see that by 2009 it was a steep drop, like 30% down. So I lost a bundle. Oh well, so. And you can see stock prices, everything was going up. Everything looked real rosy, right? Look at stock prices going up. And then here was the peak, stock market peak. And then boom, there's the crash right here. So it really dropped. So the Dow Jones Industrial Average was like 50% of its peak value right there. So you can clearly see what happened here. So there's a lot of debate over who caused this whole housing price bubble. So basically, low interest rate policies of the Fed. A lot of people were borrowing money and buying houses they couldn't afford. So the low Fed funds rate. The Fed funds is the money that banks will loan to each other, right? They led to low mortgage rates, and the housing demand went up. And that's when the subprime mortgages started. And basically there was a boom on housing. And eventually there was a bubble. And Ben Bernanke, who was chairman of the Fed, said that really wasn't the culprit. They weren't the culprit. The culprit was the proliferation of new mortgage products. The new products that lowered mortgage payments, such as the CDOs we saw and all the other adjustable rate mortgages and, long-term mortgages. And to this day, there's still a battle over this. Alrighty, I'll make part 4